Let's start with a simple question. Have you ever wanted to own a tiny piece of Apple, or Tesla, or Coca-Cola? To literally have a financial share in the success of a massive, global company? Well, that's exactly what a stock allows you to do. But if the idea of the stock market seems confusing, intimidating, or like a giant casino for rich people, you're not alone. The language alone can be a barrier. Bull markets, bear markets, PV ratios, dividends. It feels like a club you need a secret password to enter. But what if I told you the core concept is incredibly simple, and that understanding it is one of the most powerful things you can do for your financial future? Welcome to the Ultimate Beginner's Guide. We're going to strip away all the complexity and answer the fundamental question, what are stocks, and how do they actually work? At its absolute heart, a stock, also known as a share or equity, is simply a small piece of ownership in a company. That's it. When you buy a stock, you aren't just buying a piece of paper or a ticker symbol on a screen, you are becoming a part owner of that business. Now, let's be clear, unless you buy millions of shares, you are not going to be able to call up the CEO and tell them how to run the company. But on a fundamental level, you now have a legal claim on a tiny, tiny fraction of everything that company owns: its buildings, its patents, its brand, and most importantly, its future profits. Think of a company like a pizza. The whole pizza represents the entire ownership of the company. A stock is just a single slice of that pizza. Companies create these slices, these shares, and sell them to the public to raise money. This process is called an initial public offering, or IPO. So, why would a company do this? Why would they sell off little pieces of themselves? The reason is capital. Companies need money to grow. They might want to build new factories, invest in research and development for a new product, expand into new countries, or pay off debt. They could borrow money from a bank, but that means taking on debt and paying interest. Instead, by selling shares, they are essentially bringing on a large group of new owners who are betting on the company's future success. In return for your money, you get that slice of ownership and the potential for your investment to grow. This is a crucial point. When you buy a stock in the primary market during an IPO, your money goes directly to the company so it can fund its operations and ambitions. But for most of us, that's not how we buy stocks. The vast majority of stock trading happens in what's called the secondary market. This is where it gets interesting. The secondary market is what we typically think of as the stock market at places like the New York Stock Exchange or the NASDAQ. This is not where companies directly raise money. Instead, it's a giant, global marketplace where individual investors like you and me buy and sell our slices of ownership from each other. So, if I buy a share of Apple today, I'm not buying it from Apple, I'm buying it from another person who decided to sell their share. The price isn't set by Apple, it's set by us, by all the buyers and sellers in the marketplace. This leads to the million-dollar question: what makes a stock's price go up and down? The simple answer is supply and demand. But let's dig deeper. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. But what drives that desire? It's a combination of factors, primarily a company's current and expected future performance. If a company like Tesla reports amazing earnings and announces a breakthrough in battery technology, more people will believe it's a great company to own a piece of. Demand for the stock will increase, and the price will rise as buyers are willing to pay more to get in. Conversely, if a company like Coca-Cola has a major product recall or loses market share to a competitor, confidence in its future may fall. More people will want to sell their shares, and the price will drop as sellers compete to find buyers. But it's not just about the company itself. The overall economy plays a huge role. In a strong economy, people are more optimistic and more likely to invest, pushing stock prices up. This is called a bull market. In a recession, fear takes over, people sell, and prices fall. A bear market. Interest rates, news events, and even social media trends can all influence investor sentiment and cause prices to fluctuate in the short term. This is the number one thing beginners must understand. In the short term, the stock market is driven by emotion and sentiment, which makes it volatile and unpredictable. But in the long term, it's driven by the actual earnings and growth of companies. Now, how do you actually make money from owning stocks? There are generally two ways. The first way is through capital appreciation. This is the most straightforward concept. You buy a stock at one price and hope to sell it later at a higher price. The difference between your buy price and your sell price is your profit, or your capital gain. For example, if you buy one share of Amazon for $100 and sell it a few years later for $150, you've made a $50 capital gain. The second way to make money is through dividends. Not all companies pay dividends, but many established, profitable ones do. A dividend is essentially a portion of the company's profits that is paid out directly to its shareholders, usually on a quarterly basis. Think of it like your tiny share of the company's earnings. If you own a stock that pays a dividend, you get a small cash payment for each share you own, regardless of whether the stock price has gone up or down that day. This can be a powerful source of passive income, and many long-term investors reinvest their dividends to buy even more shares, a strategy that harnesses the power of compounding. So, with all this in mind, what's the actual difference between investing and trading? This is a critical distinction. Investing is typically a long-term game. An investor buys stocks of strong companies with the intention of holding them for years, or even decades. They are not overly concerned with daily price swings. They are betting on the company's ability to grow and increase its profits over a long period of time. This is the philosophy behind legends like Warren Buffett. Trading, on the other hand, is much more short-term. A trader might buy and sell stocks over days, hours, or even minutes, trying to profit from the market's short-term volatility. They are less concerned with the company's long-term fundamentals and more concerned with technical charts and market momentum. For the vast majority of beginners, a long-term investing approach is far more accessible, less stressful, and has a much higher historical probability of success than trying to time the market with frequent trading. Before we wrap up, let's talk about how you can actually get started. It's easier than ever. You'll need a brokerage account. Think of this as your gateway to the stock market. There are many online brokers available today that allow you to open an account with very little money and trade stocks, often with zero commission fees. Once you fund your account, you can research companies, place buy and sell orders, and monitor your portfolio right from your phone or computer. A pro tip for absolute beginners is to start with what are called ETFs, or exchange-traded funds. Instead of buying a single stock, an ETF is like a basket that holds dozens or even hundreds of different stocks. For example, an S&P 500 ETF would give you a tiny piece of the 500 largest companies in America all at once. This provides instant diversification, which is a key principle of risk management. It's much safer than putting all your money into one or two individual stocks. Now, for the most important part of this entire discussion. A clear and responsible disclaimer. Investing in stocks is one of the most powerful tools for building wealth over the long term, but it is not a get-rich-quick scheme. All investing involves risk, including the very real possibility that you can lose some or all of the money you invest. The stock market is volatile, and prices can go down sharply for reasons that are difficult to predict. You should never invest money that you cannot afford to lose, and that includes money you might need for rent, bills, or an emergency fund in the short term. It is crucial to do your own research, understand your personal risk tolerance, and consider seeking advice from a qualified financial advisor before making any investment decisions. The goal is not to make a fortune overnight, but to build wealth steadily and responsibly over time. So, to bring it all together, a stock is a share of ownership in a company. Companies sell shares to raise capital for growth, and we trade these shares on public exchanges. Prices move based on supply and demand, which is driven by company performance and investor sentiment. You can make money through price appreciation and dividends, and the most reliable path for most people is a long-term, diversified strategy. Start by educating yourself, open a brokerage account, and consider beginning with broad market ETFs to minimize risk. The journey to financial literacy begins with understanding these fundamental building blocks. You now have that foundation. The next step is to take action, start small, and stay consistent. Let me know in the comments what company or ETF you're most interested in learning more about. Thanks for watching, and I'll see you in the next video.